Our next guest is also focused on the Fed, but says it's the labor market that holds the key in 2024 to sustaining market expansion. Let's bring in Mark Luschini, Chief Investment Strategist at Janney Montgomery. And Mark, we know the labor market is important. What specific data will you be watching? We have ADP tomorrow and JOLTS data, job openings, right before we hear from Powell.
Well, you mentioned the latter to me is a little bit more important. The JOLTS report, I'd be looking inside that number for the quits rate, which is holding at 2.2%, which is in line with pre-pandemic trends. I'd also be looking at the job vacancy rate. This is something Governor Waller had noted as it continues to move lower from current levels of around 5.3% toward what he believes around a 4.5% rate, which could trigger an acceleration in the rise in the unemployment rate. I'll be looking for that. And obviously later in the week, jobless claims, which have been hovering near historic low levels, and obviously culminating on Friday with the BLS number on jobs. And so a lot of activity on the jobs-related market that'll give us a purview into how well that's going to stay conditioned to be able to provide the income stream and the wherewithal for consumers to continue to propel economic activity.
Mark, as to how investors should be positioned, you're saying this rotation away from tech into industrials, energy, that's where investors should be looking for opportunity. But you could argue those sectors have all seen that rotation, the run-up this month.
Well, they have, but that's also relatively fresh. I mean, these were the sectors that were really laggards last year, obviously with the domination by tech and tech-related companies that continued in earnest over the first couple of months of this year as well. It's only more recently that you started to see these other sectors usurp tech leadership, and even communication services has only recently given way a little bit to these sectors. And so I still think there's more horsepower embedded in them, particularly given the fact that the U.S. economy continues to elicit signs, for the most part, that it's still quite stout. And we're even starting to gather some evidence, albeit somewhat embryonic, but nonetheless, that global activity is picking up with better news coming out of Europe and China alike. It's so important to the big large cap multinationals that propagate those sectors like materials and energy and industrials.
Since you mentioned Europe, let's talk about one of your choices, which is BMPPRA, with a nearly 7% dividend yield on its ADR.
Huge dividend yield, obviously attractive for investors who are looking for not just current income, but total return, which, starting off with something north of a 6 handle gets you a long way towards a pretty exceptional prospect for a total return. But, it's the largest financial institution in Europe, banking institution, 9th largest in the world by assets, trading at about 7 times a multiple on earnings and trading at about 30% below book value, with signs of improving conditions in the European economy. Leads us to believe that BNP is undervalued and a re-rating is at hand.